Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. I'm pretty excited about this week's class because it's actually going to talk about a topic which is quite interesting if you really get to understand it, because it's going to help you to improve your trade entries and also increase tremendously increase your risk to reward ratios for the trades you're taking, especially if you're swing trading. Okay, so that's the topic which we're going to be talking about today. And as you probably know by now, it's titled How to Trade with Multiple Timeframes. Okay, so that's basically what we're going to be doing. So, to quit beating around the bush and just dive right into the topic, most inexperienced traders, okay, the way they think about trading is they just find the time frame they like and then they stick to that time frame and just trade with it regardless of whatever happens. Okay, so for example, you might find a trader who will tell you that, okay, his trading strategy, okay, or the trading strategy he learned, maybe he just uses it to trade on the 1 hour time frame. Now there's nothing good or bad about this, okay, it's just that it's quite limiting. Because here's an analogy, okay, to think about it. Imagine you're trying to go to somewhere, okay? You're trying to travel, for example. And then that place that you're trying to go to, you only have kind of like an old, handwritten map or something that's just showing you where you're going to go. But you don't have a bird's eye view of, okay, what country is that place you're going to? What country is it situated in? And then not only the country, but what state or what jurisdiction is that place located at? And then what locality is that place in? You all you know is that, okay, you want to go to the name of the street, just insert name of the street here, and then that's just where you want to go. So even though if you were to find yourself on the street, you might be able to navigate around the whole street because of that hand-drawn map that you'd have, you still would find it hard to really get a good picture view of where you currently are, whatever the case might be. And that's kind of a rough analogy to give you an understanding of what trading with one time frame is. Okay, so when you're trading with one time frame, you're basically just having that restricted view of what is happening on that time frame alone. While the person who is trading with multiple time frames, he can switch to the higher time frame to see what, with a bird's eye view, what the whole kind of move or the sentiment in the market is. And then he could move to a time frame which is lower than the time frame that he stays on to actually find his trade setups, to find laser tight entries. When I say sniper entries or laser tight entries, I actually don't mean entries that will not mean you're not going to get losing trades at all. No, I just mean entries that will help you to reduce your risk per trade sensibly and then increase your risk to reward ratio. Because by now, if you've been attending any of these classes, you probably know that trading with good risk to reward ratios, positive risk to reward ratios, is absolutely crucial, especially for trading strategies that have got an average win rate which is in the ballpark of 50% or less than 50%. Because if you're trading with a trading strategy that has a positive risk to reward ratio, meaning, for example, whenever you risk one, you're aiming to make at least two or more than two times whatever you're risking on average, then if you're trading with that type of trading strategy and you're using it with a good risk management, okay, then with a 50% win rate, you're actually going to make a ton of money with it, okay? But if you are trading with a trading strategy that has a low win rate, and whenever you risk one, you're aiming to make one, then it's going to be very difficult for you to become profitable, especially if your win rate is, within the ballpark of like 40 or let's say 35 to 40%, okay? So now the reason, like I told you, one of the reasons is when you're trading with a view of what is happening on the higher time frame, that is going to help you to know the overall sentiment, what your bias is. And then when you crank down to the lower time frame, that is going to help you to get good entries. Some professional traders actually use the lower time frames to find, to refine their entries. But then they don't use the lower time frames to find the profit target for the trade setups they are taking, because they're trying to limit their losses while trying to capitalize on the big picture move to maximize their profits as much as they can. Because as you probably know, again by now, trading is a game of risk to managing risk. Okay, when you're a trader, I like to tell this to a lot of guys that trading is all about risk management. Okay, yes, there's the technicals and all of that, but the reason why I say trading is mainly about risk management is because whichever trading strategy or methodology you choose to use, you might even just be winning like 30% of the time on average after taking a lot of trades. But if you have a good risk management strategy or technique and you're keeping your risk consistent and you know what you're doing, trust me, you're going to actually make a ton of money even though you're not right most of the time. Okay, so let's move on with the class and then we'll talk about what exactly this trading with multiple time frames thing is, and then how to find good opportunities using this multiple time frames analysis approach. Okay, so let's move on. Okay, so as you can see on the screen, this is the chart of the Euro USD currency pair. And this is actually the 1 hour time frame of the chart. Now, to give you an example of what I mean by trading with multiple time frames, we're going to be doing a top-down analysis all the way up from the weekly time frame down to whatever trade setup time frame we're going to be using for this example. Okay, so let's move on to the weekly time frame. So let's try to imagine that we're not using anything fancy, any fancy trading strategy with complicated terms and all of that. No, we're just using simple support and resistance trading. Okay, so assuming, okay, I don't want to go all the way far back here, but you'll get the idea very soon. So let me just pick this horizontal tool here, this horizontal line tool, and then we're going to use this as an example. Okay, this particular resistance area. Okay, why? Because in the past, let me quickly pick this. In the past, price has tried to come to this area. Okay, so let's just say we were in an uptrend based on market structure because we were forming highs and higher lows, higher highs, higher lows, higher highs and higher lows. So what we were expecting was that when price made this high and it pulled back to form this low, and then it got wicked out here, we would have been expecting price to continue moving up if the trend was truly a strong uptrend. But you can see that when price came to the area of the previous resistance zone, it was barely breaking above this area because we had a lot of price rejection. You can see the wicks forming all the way here. Okay, so we went from forming the market structure of an uptrending market, which is constituted by the formation of higher highs and higher lows, to all of a sudden price struggling to break above this resistance area. Okay, so this would have been our first warning sign that it seems like this particular uptrend might just be, either coming to an end, or we might just be having some, consolidation or whatever the case might be. Price is struggling to continue that uptrend. Okay, because ideally in a strong uptrending market, price is supposed to continue forming higher highs and higher lows, but nothing lasts forever. So as we started seeing this wicks and all of this in and around the previous resistance area, this would have been our first warning sign. And then not only that, when price pulled back, even though it formed a higher low, because when you compare this low, okay, let me drop this because when you compare this low to the previous low, you can see that it's actually higher than it. Okay, so let's assume that we've seen this. Price is technically, price is still forming higher highs and higher lows. Okay, but then notice that whenever price comes to previous areas of resistance, this zone, it finds it very hard to continue moving up. Okay, and so when we would have seen this price action forming on the charts, let me quickly pick this. This would have been a zone of interest for us. From the moment price started finding difficulty breaking above this area here, this would have been an area of interest for us. And then let's fast forward to the time where we had price come back to this area trying to break above it, but it failed to do that. Now, on the weekly time frame, this might just look like, okay, it's a couple of candles that price was struggling to break above this resistance area and it failed to do that. But then when you go to a lower time frame like the 1 hour chart, this is actually a ton of candlesticks price action that you could see here, which you could also take advantage of. Okay, so now I've cranked down to the 1 hour time frame to really show you guys the example I'm trying to drive home here. Okay, so before we do that again, so that you just get an idea of why I'm even pointing at the charts, let's go back to the weekly time frame once again. Okay, you can see that, like I told you, price was in an uptrend. It was forming higher highs and higher lows, but then all of a sudden it was struggling to continue breaking above the resistance areas to continue forming higher highs, and we started getting a lot of rejections here. So from the moment when we would have started spotting this on our price chart somewhere around here, this would have been a warning sign that, okay, it looks like price might just be reversing to the downside. And so when price revisited this area in and around here, okay, we would have been keeping an open eye for the market structure or the change in character on the lower time frame, because that will signal to us that there's a short trading opportunity, because it's likely that price is finding it difficult to continue. Price is finding it difficult to continue moving up. The chances that it's going to move down, even if it's temporarily, are very, very high. And on the higher time frame, it might just be 1 or 2 candles just, coming down or whatever. But for the lower time frames, that move might be a couple of 100 pips, even for a currency pair that is not as volatile as the other pairs, a currency pair like the Euro USD. So let's move on to the 1 hour so that I can show you exactly what I'm talking about here. So when we go back all the way back to when this price action formed, remember I placed an arrow here to actually make it visible on the charts for you to see and make it easy for you to identify it. Okay, good. So you can see this is the arrow of the second time that price came to this area, trying to break above it. So now I want to draw your attention to the price action, the market structure that we had when price was forming this. So remember, price earlier came and it tried to break above this area and it failed to do so in the past, okay? But then now that it's revisiting this area, again, when it came to the proximity of that area, whenever it comes like it wants to break above this resistance area, it comes down. Whenever it does that again, it comes down. So now, using our knowledge of market structure, if you've been attending these classes, we've talked about market structure countless times on the ITU Forex classes. So this is one of the places that you would want to put that to use. Okay, so let's assume you've spotted on the charts that, okay, price is making highs, okay, higher highs and higher lows. Higher highs, higher lows. What characteristic is the formation of higher highs and higher lows in the market? That is the characteristic of an uptrending market. But then trends don't last forever. So even though price is forming higher highs and higher lows, there's definitely going to come a point in time where price is going to struggle to continue forming those higher highs, especially in for a trend that is weakening. And then price might just start forming equal highs, which is double tops for chart patterns that are called double tops. Or price is even going to struggle to form a high which is going to be equal to the previous high where it got rejected at. And then when that happens, that's a warning signal that the trend is no longer as strong as it used to be. And what is our final confirmation? Our final confirmation will be when price breaks below a higher low and then starts forming lower lows and lower highs, because by then we would have shifted from forming the market structure of an uptrending market to forming the market structure of a downtrending market. And so then when we combine it with our high time frame analysis, we are going to use it to find low risk, high probability trade setups. So moving on. Here, price was forming higher highs and higher lows, higher highs and higher lows. But if you're using multiple time frame analysis, this would not deceive you, in the sense that you already, because of this gray shaded area we know what happened on the higher time frames. Whenever price comes to this area on the weekly chart, like we saw, it struggles around this area. It gets rejected. It starts to weak. It starts to do all sorts of things like that. So we are not going to be, deceived that price is going to go up endlessly. And then our warning signal is already here, because price was forming higher highs and higher lows. But then when it came, to the proximity of this area, it now started struggling to make decisive lows, decisive highs. Look at what I mean by a decisive high is this is a high and this is a higher low. This is a higher high. When you compare this higher high to this previous high, you can see that price actually broke above this resistance area with a decisive move. It really gave it distance. But then when you compare this higher high with this previous higher high, you can see that price just barely broke above this area. So price is actually, the momentum that price had when it formed this move, it's not the same as the momentum that price is showing here. So price is likely starting to weaken. Okay, the momentum is starting to weaken, and that's our warning signal. Remember, I told you that's our first warning signal. Our second signal, which is the confirmation, not the warning signal, is when price is able to break above a higher low. In this case, this was our first higher low. This was our first higher low. This was the second higher low. This now is our third higher low, because when you compare this low to this one, it's actually higher. But then price is now no longer forming higher highs, because it couldn't even make a high that would test this previous high. So this is technically a lower high. Okay, and then out of the blue, price has now broken below our higher low. And then now price is now forming, let's say these are equal highs. And now price is just forming lower lows and lower highs. So we've moved from forming the market structure of an uptrending market to now forming the market structure of a downtrending market. Now, why is this important? This is important because on the higher time frame, we know the area we are. We're at an area of interest, which is showing us that whenever buyers try to push price above this area, they really get overpowered by the sellers. And so this is something that is worth noting for us. And so when we see that price getting in and around this area, and then now the strength in the market has moved from the buyers to now the sellers, this is our opportunity to take a short trading setup on the lower time frame. So when I place this short trading tool, because now price is forming lower lows and lower highs, using even a break and retest trading strategy methodology or whatever the case might be, you could take a short trading position at the close of this bearish engulfing candlestick. If you want an aggressive stop loss, you can place your stop loss just above this resistance area. Okay, and I keep telling you guys about aggressive stop losses. When you're using aggressive stop losses, yes, you're going to get a lower win rate because you're going to get stopped out more often than not. But the positive side of using it is that you're going to have a higher reward to risk ratio for your trades. So even though you are going to have a lower win rate, because on average you might be going for 1:5 or 1:10 or whatever the case might be, your profits are going to way outweigh your losses. And so even though you have lower win rate, that profit is going to overcompensate for that. Somebody with a higher win rate than you might not even make as much profit as you are making. But then it all comes down to your type of psychology. You need to know what type of trader you are. If you're a trader who knows that if I get 2 or 3 or 5 losing trades in a row, it tends to disturb me and I start breaking the rules of my trading strategy, then using the aggressive stop loss approach might not be for you. And if that is the case, you might want to use the conservative stop loss approach, which in this case would be you placing your stop loss above the area or point of validity. Because what I mean by point of validity is that price is now forming lower lows and lower highs, lower lows, lower highs, lower lows and lower highs. If for whatever reason, after you get into the trade in and around this area, price is able to come back and break above this resistance zone, then we're no longer in a downtrending market, because by definition, the market structure of a downtrending market is the formation of lower lows and lower highs. If for whatever reason price is no longer forming lower lows and it's now forming a higher low, then obviously you don't want to be in the trade, because the reason why you even got in the trade in the first place has been invalidated. And that's what I mean by a point of validity stop loss. So for someone using the conservative approach, you want to place your stop loss where if price was to go to that area, then your trade is no longer valid. It's invalid, and so you're going to take your loss and move on to the next trade. Okay, so for those who would have been using a aggressive stop loss, maybe your stop loss might be somewhere around here, just above this bearish engulfing candlestick. But then pay attention to what happens. You would have been stopped out here, but then you would have also seen this short trade setup again and know that, okay, you could still enter into this trade because the point of validity has not been invalidated. Price has not broken above this resistance area and started moving up. So technically, this downtrending market is still intact. So you could have taken this trade, maybe aim for a 1:5 or 1:, whatever the case might be, and price would have easily hit your profit target. Okay? So this would have been a trade. In fact, it would have been a trade that could have easily done almost a 1:8 here, or 1:7, or whatever the case might be. Okay, this is using the aggressive stop loss approach. Remember, we started our analysis from the higher time frames and then we worked our way down. Okay. Now, what if you were using the conservative approach? And this is where I told you that there's a it's pros and cons. You need to weigh in what fits you better. Okay. So if we're using the conservative approach, your stop loss would have been somewhere around here. And if your stop loss was somewhere around here, then obviously your profit target is going to be affected. And so because your stop loss is going to be a little bit further, your profit target is also going to be affected. It's going to be further now. And so you notice that people who are usually using the conservative approach, their risk to reward ratios are much lower. Reward to risk ratios are much lower than people who are going for the aggressive approach. They might have slightly higher win rates, but they might not make as much profits as the people who are using the aggressive approach. Okay? See, this all comes down to preference, what you prefer. Okay? So now, this would have been our trade setup. Okay? Now, when I go back to the weekly time frame so that you can see the setup we had here, when I go back so that you'd see it clearly, let me quickly do this. You'd see that this would have been the trade, though. You see? Price was forming higher highs and higher lows, but then when it reached this area, it started struggling by the formation of these wicks and all of that. And then when price revisited this area, we saw the change in market structure. And then on the lower time frames, we saw when the structure was broken, change in structure, change in behavior, change in character. We saw when that happened, and then we took a trade and we would have banked our profits here. Okay? Now, why is this important? Why is multiple time frame analysis in this particular example? Why is it important? It's important because most of the times you see that setups that you identify on the higher time frames, they tend to have much more power behind them, much more momentum. And not only that, another thing you'd notice is that if you were to have taken this trade on the higher time frame, on the weekly time frame, by virtue of it being a higher time frame, automatically you would have maybe taken the trade when this bearish engulfing candlestick finished forming. And since this is the higher time frame, your stop loss would have been all the way above this resistance area if you're using the conservative approach. Remember, I said the reason why you would use the conservative approach is because if price breaks above the place that your stop loss is placed at, which in this case would have been above this higher high, then we're no longer forming the market structure of a downtrending market, which is what you are even banking to take that trade. Okay, so if you were to take this trade using the conservative approach, your stop loss above here, and then you were going for a simple 1:2 risk to reward ratio. Okay, just look at what would have happened, because now you've identified the trade setup on the weekly time frame, and you're not doing any refinements on the lower time frame. You are taking the trade on the weekly time frame as well. Just look at what would have happened. You would have taken this trade. Each candle you're seeing on this time frame is a weekly candle, so it took it one whole week to form. So at the close of this bearish engulfing candlestick, for example, you would have taken this trade, this short trade setup, but then price took 1 or 2 weeks moving in your favor and you would have been happy and whatnot. But then all of a sudden price moved deep into your stop loss region, and it even ended up taking your stop loss. So you would have waited around 1, 2, 3, about 4 weeks, a whole month, for price to hit your stop loss. Okay, so you would have waited a whole month. You just took one trade on this currency pair, and eventually price hit your stop loss. And even if, for example, let's assume that, let me use it with another setup, that let's say price is still struggling to break above this resistance. We had the formation of this hammer candlestick and whatnot. And so at the close of this candlestick, because it is a price rejection candlestick, you took the setup on the higher time frame. This is me showing you the advantage of using lower time frames to define your entries. Okay, your trades are going to hit your stop loss or profit target much sooner, and so you're going to be in and out of trades much sooner. Okay, so if you were to take this trade on the higher time frame, your stop loss, point of validity stop loss, if you're using the conservative approach, would have been above this level, this candle, this pin bar. And if you're going for, if you're using proper risk management, you're keeping your risk consistent, and you're going for a 1:2 risk to reward ratio, just look at what would have happened. You would have taken this trade around here, and then even though it's been 1 candle, 2, 3, 4, 5, 6, 7, 8 candles, around 2 months, price has not reached your 2-hour profit target. So you can imagine, you're trading, and then even though you've held a trade for almost 2 months, it hasn't come anywhere near it hasn't even hit your profit target. So this is one of the reasons why you don't want to trade the higher time frames all by themselves. Yes, you want to locate points of interest on the higher time frames so that you can come down to the lower time frames, and then when you see something that agrees with what you saw on the higher time frame, on the lower time frame, you will now take trades in the favor, take those trades on the lower time frame and take advantage of them sooner. So like this particular pin buy example that I was showing you here, let's assume you saw this setup when this candle closed on the higher time frame. Let's assume you saw it, and then because you know the disadvantages of trading on the higher time frame, it takes long, and then all of these things, you decided, okay, you know what, at the close of this candle, I'm going to go to the 1 hour time frame and look for an entry to the short side. Okay, because why am I looking for an entry to the short side? Number one, price has gone from forming higher highs and higher lows to now even struggling to break above this resistance area. And so clearly, price is struggling to continue moving up. There's a weakness by the bulls. And so after you see this price rejection candlestick, we know that that weakness is being confirmed. So now we want to go to the lower time frames. And if we see a shift in market structure from the formation of higher highs and higher lows, which is the market structure of an uptrending market, to the formation of lower lows and lower highs, we know we have now shifted from moving in an uptrend to the downtrend. And so when we get a break of structure or a change in character, we're going to take the short trade on that particular lower time frame, capitalizing on what we saw on the higher time frame. Okay, so now let's go to the 1 hour time frame. I've placed an arrow here to show you this example clearly. Okay, so as you can see, this is the arrow I showed you. And you can see price was, remember we had the formation of that pin bar candle, that long hammer candlestick. And that was formed because price was forming higher highs and higher lows, higher highs, higher lows, higher highs. And then all of a sudden, price could not even form equal highs here. And then it moved from forming higher highs and higher lows to now it came all the way to this higher low. And then it eventually broke it. And then price switched from forming higher highs and higher lows to now forming lower lows, okay, and then lower highs. Lower lows and lower highs, for example, okay? So this would have been our cue that price has switched its direction, okay? So now you would have gotten ready to take advantage of this trade at the close of this candle. But this would have been the end of the week, I think, when this pin bar candlestick was formed. So now price was forming lows, lower highs, and then lower lows. So let's say you saw this and then you thought it was a break and retest and you took this trade here, because showing you examples of trades that just work out it's not realistic. We have winning trades and we have losing trades also, okay? So let's say you saw this and you thought it was a break and retest and this was a good place for you to sell. So let's say you sold here and you're using the conservative stop loss approach. So your stop loss is somewhere above this resistance area, because if price for whatever reason breaks above this resistance, we're no longer forming lower lows and lower highs. And let's say you're going for maybe a 1:4 or 1:5, for example. You see price moved a little bit in your favor and then eventually it went to hit your stop loss. But then this is just a losing trade. It's normal. These things happen, okay? That's why risk management is important. But then after you got stopped out, remember, price has not broken above this resistance and continued to form the higher highs and higher lows indefinitely. It did form higher highs and higher lows, but then when it reached this area, you can see it couldn't even continue moving up. And so it eventually broke below this low, and then it came back to retest. This would have been another short trading opportunity for you. So if you're using the aggressive approach, your stop loss would have been just right above this resistance. And then you would have been going for maybe a 1:2. Again, remember the aggressive approach, the pro of that is that you're going to have, risk to reward ratios of like 5:1 or whatever the case might be. And if that was the case, in fact, even if you're going for a 1:10, price would have easily hit that profit target for you. But then if you cannot tolerate taking a lot of losses in a row, the aggressive approach might not be for you. What about the conservative approach? For the conservative approach, this was our high. So if for whatever reason price is after we enter into this short trade, thinking that we had a break and a retest, and then this price action is now going to move from forming higher highs and higher lows to now forming lower lows and lower highs. If for whatever reason after we took this trade, price reverses and breaks above this resistance area, we want nothing to do with the trade, because the reason why we entered in the trade in the first place is now nullified. And so our stop loss would be placed somewhere just above here. And then we'll be going for maybe 1:4, 1:3, or whatever the case might be. And you can see that this would have been a good winning trade. So in this whole class, I showed you an example of like 3 trades we took based on, combining all this, the higher time frame and the lower time frame, to get a bird's eye view of what's happening on the charts. And then out of those 3 trades we took, 2 were winning trades and 1 was a losing trade. If you were using the aggressive approach, you would have, if you were risking 1% of your account capital on each trade you took, you would have easily, netted around 10 or 20% on those 3 trades minus the trades that you lost. But if you're using the conservative approach, which is also good, you could have still ended up making a profit of almost 10%, even though you still had losing trades mixed into those trades that you took. What I want you to know is that if you use this technique, this does not mean that you're going to win each and every trade that you take, but it's going to significantly improve the chances of your trades working out, because you're actually using, the whole thing, higher time frame, momentum, and everything in your favor. Okay, so this pretty much brings us to the end of this week's class, and I sincerely hope that you got a ton of value from it, because this technique is one of the things that is advanced traders, professional traders used as advanced trading technique to actually just trade just using price action, okay, without even technical indicators or anything like that, and considerably increase their profit potential, their win rates, and all of that. So if you're interested, please don't forget to try it out, test it, back test it, and make sure that you fully understand it before deploying it to the live market. Okay, and before we wrap up the class, I would like to use this opportunity as usual to let you guys know about our ITU bots, which are expert advisors designed to trade on your behalf. So they're going to find those low risk, high probability trading opportunities for you, and if you follow our risk recommendations, they're going to place those trades for you with proper risk management and get you earning while you're learning. So if you're interested, please reach out to us on any of our social handles or drop a question in the comments box, and then we'll be more than happy to assist you, set everything up step by step, and walk you through how to do that. In the meantime, I sincerely appreciate you guys taking time out of your busy schedule to attend these classes and to actually put what you've learned into practice, so that it's not going to be as if you're just wasting your time coming and then you're not actually benefiting from this. So once again, thank you so much, and I look forward to seeing you guys in next week's edition of the class. May God bless you all. Have a wonderful rest of your week, and go out there and crush the markets. Cheers.